Hello, welcome to Wise Beyond Bitcoin, your home for the crypto neo news, education, and opportunities. My name is Ryan,
My name is Lucas.
and we have a special video today, another installment in our macro outlook series. This will be a smaller, shorter video. We're only going to focus on a single article, but it's in that spirit, in that subject of the Fed, monetary policy, inflation, and what all that means for cryptocurrency. A subject that's dear to our hearts. Another subject we love talking about is the secret network, the IBC in general. And as you see, we have a few videos, a couple playlists to get you started on your crypto journey or to help you understand what's going on with secret NFTs or secret in general, as well as other things, and videos about airdrops and the DeFi world at large. So check us out. We love to stay on top of all the IBC goings ons as well as secret specifically. Anything else, Lucas? Oh, yeah. Let's always be quick to let people know this is not financial advice or any other kind of advice. We have our own vices, and we sure you have your own. And we're all going to make mistakes, and we're going to do our best to share what we learn. But there will be things we don't know or don't see or get wrong. So do your own research. And without further ado, let's jump into it.
Let's do it.
All right. So the headline is really the big takeaway here. There's the UK central bank is the Bank of England. They are also in the middle of switching to an interest rate hike policy footing. And the big boss over there, Mr. Bailey, he's come out and put his foot in his mouth in a sense, and maybe not directly, but that's one way to read it. And we're going to unpack that. So what is he saying? He believes that workers, he's basically cautioning or instructing or pleading with workers to resist demanding for bigger pay raises. And this is all with the idea that this will help stem inflation. That's the big fear now is inflation. Well, I think I mean, Lucas, I
Wages.
don't want to jump into it. So what's your initial reaction here
Well,
to
we talked
this?
about this already, and the idea is that everyone understands already that prices are going up when it comes to energy, when it comes to food, when it comes to living
Mm-hmm.
costs, and their overhead. So all of a sudden, and not just on that, there's been a lot of money, as we've talked about, pumped in to certain sectors of the economy where nobody was worried about the rising tide of inflation then. But when you talk about modestly increasing people's wages so that they can start to catch up and afford to state that that is all of a sudden going to create some huge tidal wave of inflation is going to be a problem. It's a little bit disingenuous, and it's like you said, it's like a bit of that class warfare type
Mm-hmm.
mentality where it's okay to allow for inflation for certain areas of the economy. When you look at
Mm-hmm.
the financial markets in particular
Real
and other areas,
estate.
real estate.
Mm-hmm.
But then when it happens to people's wages, all of a sudden we need to be careful and keep it low. So I
Yeah,
think
right. Yeah, I think that's really, you put your finger on the core issue. This is a bit of a volley in the class war. You could think of that in that way. And so I bring up a chart to highlight this. This is a very popular chart in the last year or two. And it ends in 2010. So there's other charts that have more recent data included, but they follow this pattern is not ended. It just continued, right? So what you're looking at here is the top line is productivity. The bottom line, the light blue line, is hourly compensation. You could think of that as wage growth. Something broke in the mid 70s, right around 71, 72, 73. You see that up till that period, wage growth tracked economic growth or output. But in the 70s, something split, and all of a sudden, the growth of the economy did not seem to be widely distributed across the workers like it used to be.
you want to
And
state what
and we
that
can talk
was
about why. Yeah, there's a big monetary change that happens right here.
with
This is
Nixon.
Yeah, Nixon closes the gold window.
Mhm.
There is a removal of the last links to the dollar to gold. So that means that the supply of gold no longer served as discipline on the amount of money that could be created, right? That link was severed. So the ability to create more debt and currency and credit was now untethered from that finite scarcity of gold supply. Go ahead.
When you say links, there were different stages, right? Because there was
Yes.
the Federal Reserve Act of 1913, then there was the gold seizure act,
Confiscation. Yeah.
confiscation act,
In the
and
30s.
the 30s that changed the booking, the asset
That's
backing.
right.
So
So it wasn't all in one fell swoop.
no, it's different stages, but that was now. Why then was the dollar still demanded? Well, the dollar was still demanded because it was after the wars previously accepted that dollars would be used as the world reserve currency, which means used for settlement for payments between nations, and
Right.
therefore they demanded large amounts, and that led into the oil. All
Mm-hmm.
transactions for oil were purchased in dollars. Now big news. We've talked about this. We've seen this coming for years. It's like watching a glacier when you look at this, and it's still happening, and it will continue to happen. But more nations are starting to decouple. They were just announced recently. Russia and a
Right.
couple other countries started to no longer. They're using the euro
Right.
instead of the dollar for burden.
Yeah, I
And
saw that article. Yeah, that's big. That's a big story.
it's huge,
That
but
yeah,
it's been coming for a long time.
for
You know,
sure. So what are we talking about this for? Well, uh, let me explain it in real simple terms. So productivity is the growth of the economy, output. If you look at GDP over the last 20, 30, 40 years, it's definitely continued to grow, right? But if you look at hourly compensation and you look at the income for the median worker, it's kind of stagnated, right? And we always often hear about how easy our parents' generation had. Millennials will talk about they're priced out of a home, they're priced out of healthcare, and their income hasn't kept up in real terms. And so they're looking back at their parents and thinking, wow, you boomers had it so easy, compared to how we millennials had it. Our ability to acquire a home or to acquire these assets is just so much further removed from us. So, and I think we need to talk about, well, what led to that. And one of the big things that led to it is the vast amount of money creation and debt and credit creation that, and this is a point we often talk about, that when it is created, is loaned into the economy, is spent into the economy at certain points, and ends up going into the investment coffers of some of the most elite institutions in the United States, most of them on Wall Street. So we're printing up money, and then we're loaning it to Wall Street banks who are then using it to speculate. And if you look at the S&P or the Dow, let's go take a look. Over the last 30, 40 years, since this change in the money system, you can see clearly that, and I'm not going to go back 40 years because there's a limit, but I'll go back to 2003. You can see clearly that financial assets have done quite well, right? Many, 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 many times above where they were just 20 years ago. So, but at the same time, as we saw in the other chart, hourly compensation is kind of stagnated. So the story of the last 15, 20 years, going back to the dot-com bubble and to the reaction to that, and going back to the housing bubble in 2008 and the reaction to that, has been one speculative bubble after another, fueled by easy money, cheap interest rates, and credit creation. And these bubbles have been rooted in financial assets. So if you've owned a home during this period, if you've had a 401k, if you've had stock portfolios, you've done quite well. But if you haven't, and if you've been living on a fixed income, say like your savings at a bank, or say a pension fund, or say you just have your wages, right? You're an hourly worker. If that's your situation, then you haven't done as well. There's been a pretty good redistribution of wealth that's occurred over this last 20 years from the working classes to the asset holders. And I just bring this up as is a bit of an important context. And when you're starting to look at articles and hearing arguments about how workers need to resist inflation or resist pay raises to stem inflation, and why that's such a class war kind of perspective, when we got this context of the workers being frozen out of all the gains over the last 30, 40 years, having them being concentrated in the side of the economy that's already very, very privileged, right? The investment class. And so to put all the emphasis or the onus on the workers to resist, to fight inflation, right? And not say a word about the asset price inflation. I feel like it's hard to even listen to without a smile and a grin on your face, because this can't be serious. It's
Right.
like, you aren't serious. You cannot be serious. It's such a naked apology for a certain class that it's hard to even listen to without wanting to put clown makeup on your face, and just and have a laugh, because that's my, I'll get off, my spiel. I'll end it here, but that's my take on this.
That's why we read it instead.
Yeah, right. While I'm talking.
Because if we had to listen to it, we'd be wearing clown makeup.
Yeah, that's true.
Yeah.
It would require it.
We may have to put it on anyway when we read it,
Mm-hmm.
one of these days.
It's true, and
So
this is wrapped up too in the article. The very final paragraph, by a policy analyst at the director of High Pay Center in the UK, a think tank who focuses on economic equality. They mentioned that policymakers should be more serious, should think more seriously about how the country shares its wealth more evenly, rather than continually putting the onus on working people to make the sacrifices. Yeah, I definitely reworded that, paraphrased it in my comments, but that's essentially the point right there.
And he actually focuses not on economic equality, he focuses on economic inequality.
Yeah.
So which means he's really good at spotting the stuff out. Obviously.
Yeah, right.
If
Yeah.
you focus at inequality in the economy, then you're good at spotting out. You're like, yo, hey,
You got an eye for it.
You're like, I focus on inequality, and my friend, what you're talking about here fits everything that I study, so it's a good
Right.
thing,
Yeah, there's a need for that. And there's been a time when in my history of learning economics where I didn't fully appreciate this labor management dichotomy, and I don't want to overplay it either, because it can be overplayed, but there is a dichotomy. There's a sort of a struggle here. There's a bit of a conflict, and it doesn't do good to just forget about it and to just ignore it and pretend that everybody's an asset holder that is going to do well, when the stock market booms. It's like, well, no, some of us aren't, and some of us live off of wages, and the difference between the way wages are treated under inflation and the way asset prices are kind of just tolerated, it's definitely like a heads I win, tails you lose kind of a kind of a regime, I guess is the word.
Well, it's just, it's the game theory, the incentive structure, the way it's set up, which is why DeFi, and when you have protocols that prevent front running, which is one we talk about all the time, but you look at what's being built with these blockchain technologies, and whether it comes to the rate of inflation and how it's paid out and who it's paid out, there are many innovative solutions and protocols that are early and really taking advantage and showing the potential of this technology. And it's a great time to get involved.
It really is. And before we wrap this up, I did want to highlight this one little section. We have an individual who makes almost 800,000 a year lecturing people who probably make, a tenth or 20th of that about not demanding high wages, and how that I think that's cute.
That would absolutely, if everyone were to be paid more, that would absolutely dilute his 781,000.
Right. Well, I would say you go first, buddy. If high wages are the problem that we're worried about, then look in the mirror. Physician, heal thyself, kind of thing.
Let it dilute.
Let's let it dilute. Yeah.
Let it dilute a little bit.
Yeah. So anyway, I love the lecture from the man who's almost making $1 million a year about the harm from big pay raises. I already
tell from the posture, because I don't too often. I can't recall. It's like it already is uneasy. Is that kind of uneasy for you right now?
It's defensive. When you hear about people with defensive wounds, they're to the palms.
Okay.
And
that's right. So he feels like he's being attacked.
He feels like he's being attacked. And if I was making $1 million and lecturing other people who made fractions of that to take less pay, I would feel ready. Like I would want to get ready for the attack. So he's subconsciously aware of what role he's playing.
It's easier for me to do this. No, I'm just kidding.
But yeah,
I got 3 fingers pointing back at me, right?
He's like, don't shoot the messenger.
Oh, shucks. Okay.
All
Well, we
right.
got body language involved. We really take a look at the macro outlook. We pull back and look at the whole thing.
We do. Yeah. That's what we're here for. Well, Luke, it's always a pleasure shooting the breeze with you on macro issues. It might be deceptive to our audience, but we did not script this. We are just that into economics and macro issues that we can just let it fly, and you get the kind of golden gems that we've made possible today.
Some golden, some coal, some
Yeah,
in between.
it's a mix.
We'll timestamp some stuff in there, and you can make a comment and share your perspective. We have live streams once a week. We really do enjoy sharing this. So look forward to more macro economic outlooks, because really the economy is an allocation of resources, labor, energy, many things. And this technology, Bitcoin, crypto, blockchain, is just a new sector, a new technology that has potential to innovate the way we go about doing things as men and women around the world. And those innovative ways, creative destruction we talk about, and others. So it's important to still look, because all of us are part of both of these worlds together. We are all involved with our feet in both worlds, just as cars were
Right.
making and planted. We're all laboring, we're all working to help fill the grocery stores and build the homes and keep the energy going, while some people are tinkering away on new technologies and some people are tinkering away. It's definitely a very beautiful coordinated hive of man development.
Ecosystem
Yeah.
or ecology. That's another one.
Yeah.
For sure. Yeah, it's all related. And that's why we're focusing on these macro issues. We feel that, being abreast of these things gives you an input into understanding where markets are heading in general. So there is a utility into paying attention to policy and what policymakers are moving and thinking about. So we will keep an eye on it, and stay with us, subscribe, share, comment, and we will be making more of these macro videos as well as how-to videos for the IBC and Secret Network. So we'll see you in those.
Have a beautiful day. Namaste, y'all.
Thank you.